Alright, let's talk about what's happening in the market right now. You're probably hearing everyone around you saying, pull your money out, it's a dip. But you know what? I'm actually here to tell you no. This is actually the best time to invest if you play it smart. You might be thinking, Nikhil, have you lost it? No, not at all. This is a super logical investing concept and I'm going to break it down for you. So, if you want to go from just being an investor to a smart investor, stick with me till the end. But let's address the big elephant in the room. The main reason why regular folks like us, retail investors, lose money in the market, it's FOMO, fear of missing out. You see your friends, your colleagues, even your auto driver bragging about how much money they made in few months because some stock went crazy and you feel like you're actually missing out. So you jump in without doing any research, homework, and without even a strategy. This is exactly the opposite of what big guys do, the institutional investors, and that's why we lose money. Let me walk you through the typical retail investor's cycle. When the market is stable or going down, we tend to stay away. Remember the COVID-19 crash? Nifty 50 dropped almost 50%, and where were we? Sitting on the sidelines. Meanwhile, the smart money, the institutional investors, they were actually pouring billions into the market. Why? Because they know downturns are buying opportunities. Stocks are cheap, everyone's scared, and they capitalize on the panic. Then the market starts to recover. Headlines scream, bull market, stock are 20, 50% up. This is when we start to get interested. We want to ride the wave, but here's the kicker. By the time we jump in, the institutions have already made their big gains. We are buying high, which leaves us vulnerable. In some time, the market skyrockets, it's up by 100% thanks to traders and momentum. Now it's all over the news, and we are now rushing in, afraid to miss out on even more gains. But guess what? This is when the smart money exits, locking in their profits. Then stock would start to drop. You will start averaging by buying more, expecting that it will hit the all-time high again. And when the stock corrects quite a bit, we panic, we sell at losses. And then the institutions come back in buying at those low prices, completing the cycle. It's a loop, and retail investors always get stuck in the wrong end of the loop. Let's look at a real life example. HAL before pandemic was soaring above 1000 rupees. When COVID hit, it plummeted to 350 rupees or so. Many panicked and sold. But the institutions, they saw the potential in the defense sector then and then bought heavily. 3 years later, HAL gave 10x plus return, reaching new highs. Those who held on, they won big. But when everyone started talking about defense boom, that was the signal to exit. And those who bought then are now sitting in red. Told you that loop. Now, from what I've seen, there are three main reasons why retail investors struggle. One, high conviction on losing stocks. We hold on to losing stocks, convinced they'll bounce back. This can lead to huge losses, sometimes 50% of your portfolio. That's a big mistake. Two, failure to cut losses. Knowing when to get out is crucial. We wait too long hoping to recover our principal, but the market keeps dropping. 3. Emotional decision making. Greed during a rally, fear during a crash, that's what drives us, and it leads to terrible timing. And how do we fix this? Here are 4 takeaways. 1. Buy when others sell. The best opportunity comes during crashes. When everyone's saying how bad the market is, that's often the time to buy. This applies to crypto too. The thumb rule is when there's greed, sell, when there's fear, buy. 2. Follow fundamentals, not hype. Don't chase hot stocks. Focus on companies with strong fundamentals, like defense during COVID, because macros indicated money will be pumped into the market towards infrastructure growth to keep the GDP in growth. It became a clear winner for those who look beyond panic. 3. Understand institutional playbook. They invest without emotion. They buy undervalued assets when the market is down and sell when we push prices up. 4. Cut losses early. If a stock drops and your investment thesis no longer makes sense, don't hold on for miracle. Take the small losses now, save yourself from bigger one later. Obviously rotate that into a better stock. In conclusion, the key to minimizing losses and escaping this trap is to think and act like a smart money. When fear is at its peak and markets are crashing, that's a time to invest. Especially in one-time events like COVID, you should mobilize and invest heavily as such opportunities. I'm not being sensitive, but such opportunities rarely come. But when greed and euphoria take over, it's time to exit, just exit from the market. Whether it is stock, crypto, or anything else, the golden rule is the same. Stay unemotional, focus on fundamentals, and invest for long term. The next time someone tells you to sell during a crash, remember, that's your signal to buy. Be brave, be patient, and let your money grow smartly. That's it from me. I'm Nikhil Varghese. Share this video and subscribe to learn how to make your finances less tricky with FinNiki.